Well, Tim Wyborn is a managing partner and investment advisor at Emmanuel Wyborn and Lower Private Wealth. They're a leading boutique investment advisory firm with offices across the country, servicing family offices and ultra high net worth individuals, advising on everything from bonds and equities through to private equity and digital assets. He joins us now. Tim, welcome. We're going to take a look at the world of alternative investments. That certainly is in favour at the moment as far as many investors are concerned. What attracts you to alternative investments?
Yeah, well, firstly, thank you very much for having me. It's a pleasure to be here. I look forward to the discussion. I think, alternative investments is probably something that's really come to favour over the last 2 years, and I think it really comes down to the optionality. 3, 4, 5 years ago, when we were first looking at this space for our clients, there really weren't that many options that you could access in Australia. But what we're seeing is the democratisation of the asset class in Australia, which is really encouraging. So historically, to access something like a private equity fund out of the US or Europe, you would have needed $10 million or $100 million, and you would have been locked into that fund for 10 years plus. Your expected return on that would be 20 to 30%, otherwise you wouldn't bother. So obviously that's not palatable for everyone, it's not palatable for most people, but I think what we're seeing is that Australia is actually becoming very appealing for these global private equity brands to not only invest in our great Australian businesses, but also to allow investment from Australians, from that huge pool of superannuation that we manage. So we're seeing the democratisation where the minimums are being dropped from millions of dollars to hundreds of thousands, or sometimes like increments of tens of thousands of dollars, and you're no longer locked in for 10 years. It's more of a quarterly liquidity window. So we're getting access to this great product for much better terms than we have historically.
Yeah, okay, so it certainly provides that flexibility, as you say, with certainly greater liquidity. So interesting to see what's going on in the Australian market at the moment. More evidence today, in fact, with a bid lobbed for Domain. It appears that those listed companies, well, there's fewer of them. And that's why perhaps investors are looking for that opportunity in private companies. So what are you doing in terms of perhaps with listed and unlisted assets?
Yeah, so you're right. So the pool of listed assets available to us is not growing as fast as it has historically. So less and less businesses are listing on the stock exchange, meaning that there's less to choose from than there has been historically. And we're seeing the reverse happen in private equity. So in private markets, you're getting more and more companies stay unlisted for longer, hugely because there's more capital available to them. So what we're seeing is a lot of kind of mid-market or secondary private equity funds being available in Australia. We particularly like the small to mid-market. So the large cap market of private equity is kind of $30 billion plus, which in Australia terms is a pretty big company anyway, but in the US, that's a relatively small company. I think the 1% of capital the 1% of opportunity is being chased by most of the market in the US, in the large cap space. Versus the smaller end of the market is largely, it's much less competitive, meaning that you can get a lot better deals in that space. So we really like the small to mid-market private equity space at the moment. We're also looking at unlisted property and unlisted infrastructure. So as soon as you make the jump from listed markets to unlisted markets, you pick up what's called the illiquidity premium, which is usually in the realms of kind of 3, 4, 5%. And all that is, it's the amount you get paid for the inconvenience of not having immediate access to your capital. So in infrastructure, we like infrastructure purely. It's contractual revenue. You get paid rain, hail, or shine. If the outlook's a little less certain in listed markets, as we think it is at the moment, who knows how this year's going to play out with what's going on around the world. When you've got contractual income stream, it's really appealing. Property market's the same. We like that for the same reason, and you've got a lot of forced sellers in the market. So if you can come to the market or the property market and buy off someone that's a forced seller, that's always going to work out better for the buyer, and that's exactly what we're seeing at the moment.
Tim, are you interested in private credit? I mean, that sector is certainly booming at the moment. There's been a lot of interest there. Or is that hold attraction?
Yeah, it's definitely attractive. You can pick up kind of 10% income return for very little risk. I think if you're targeting a little more than that, you start to risk the loss of capital. But around the 10% tends to be the sweet spot. 8, 9, 10%. You can get some pretty good quality credit. The only caveat to that would be I'd just be very, very careful as to who you're dealing with. I think there's a lot of funds in the market that have just taken on huge quantums of capital. They've started as kind of $100 million fund, they've gone to 500 million, and now some of them are a couple of billion. And it just gets harder and harder to place that money. So naturally, they have to go up the risk curve. So we're very wary of managers in that kind of bucket. But there's still plenty to choose from. So yes, we're very excited about that space. It's 10% is what you expect out of the equity market every year. So if you can get that out of an income return, which is typically less risk and contracted, it's much more appealing.
And Tim, are you seeing enough opportunity here onshore in Australia, or do you need to look beyond our borders?
Australia has some great opportunities. We're certainly investing in the space in Australia. There's really are some great credit funds, and I think the banks haven't really been that interested in Australia in particular over the last 5 years. I think they actually are starting to come back now, making it a bit more competitive. But we are also seeing some great funds offshore. So I'd say it's probably 50-50 at the moment. Obviously, offshore, there's much larger pools of capital and much more opportunity. Australia's about 2% of the global opportunity set, so it only makes sense that you're going to find great opportunities offshore. But having said that, we all pay our bills in Australian dollars, and there are some great opportunities here still.
Now, Tim, speaking of risk, I see that you're looking for potential exposure in digital assets, particularly in crypto. Why is that? What are you seeing there?
So we've been following the space for probably 5 or 6 years now, and 5 or 6 years we were very nervous about talking to anyone about the space. Probably more of a personal thing that we were doing, but over the last 5 or 6 years, the asset class has really grown up. So don't think we've got enough time to go in for the investment case for something like Bitcoin, but you'd be blind and deaf if you haven't seen what's going on in the US. So Trump's very pro-crypto. You've got the SEC now very pro-crypto, pro-digital assets. You've got Abu Dhabi making a $500 million investment out of their sovereign fund. You've got 17 US states not mandate, but make it legal for them to invest in Bitcoin. You've got the US Federal Reserve talking about a potential Bitcoin or digital reserve themselves. And all of these things would move the dial independently, but they all seem to be happening at the same time. I think as Australians actually pretty ahead of the curve. I think 25% of Australians own a digital asset of some description, which is much higher than the rest of the world. So we're doing pretty well in that instance. But I think it's the birth of a new asset class. It's very exciting. You have to be very careful. It's the number one thing we've probably talked to people about. That's the risk of going to zero is still very much there. So you need to be buyer beware very much. But I think it's very exciting. It's moving at a very quick pace, and I think it would be doing people a disservice to not do our homework.